You can't fight the Fed. We've all heard that saying, you can't fight the Fed. So what does that mean? What are they saying when they say you can't fight the Fed? So what that means is, in the world of low interest rates, quantitative easing, stimulus, things like that, when the Federal Reserve is keeping interest rates low, they are reducing yields on investments for long-term assets like bonds, treasuries, things like that. So what they're doing is they're pushing investors into risk assets like stocks, equities, other things like that. So when you hear the statement, don't fight the Fed, what that means is they want risk. They want people to invest in risk assets. They're trying to boost investment in equities in other areas that present more risk than a treasury or a bond. So that's one meaning of don't fight the Fed. The other is you just can't bet against them. If the Fed is on a path of low interest rate and quantitative easing, and the Fed policy is to keep interest rates low indefinitely, then that means that we are going to continue to see a trend of low yields on those types of investments and assets, low interest rates. The banks have very thin margin, so they have to push investors into other areas so that so that there is profit out there, there's yield out there, and that there is activity, in the hopes that that will stimulate the economy and help to drive inflation. The problem is the inflation question is more of a consumer question than an asset question. We are seeing inflation at the asset level. We are not seeing inflation, hyperinflation at the consumer level. We're seeing a little bit just due to supply chain constraints and things during coronavirus. But overall, people do not have more money. The general population, the average working American, does not have more money in their pocket today than they did yesterday during COVID. It's the other way around. So the only real way to drive inflation and to spur economic activity and recovery at scale, where you can start to see some real inflation, is you got to get money into the pockets of the consumers, the average working American, the average business that either closed or is down 20, 30, 50% due to COVID, things like that. You've got to replace that liquidity. So the Fed can supply liquidity, but they cannot create solvency. They can't make a bad business good. They cannot reignite the economy. All they can do is replace lost liquidity. So it's a bigger question than just monetative easing and low interest rate policy when it comes to fighting the Fed and fighting the decisions the Fed makes. One of the biggest things you can do as an investor, as an entrepreneur, is watch the Fed, watch what they do, not what they say. Take a look at the Fed's balance sheet. You can go online to the Federal Reserve and you can look at their balance sheet, what they're actually doing and purchasing and things like that. They will make speeches here and there and kind of give indications of what's going on, but what you want to look at is, what are they really doing? What are they actually doing? Where is the money being put to work? Where is the liquidity being injected? What are they buying? And more importantly, what is being issued? Is the Treasury issuing debt? Who's buying it? Other countries, the Fed, where is that debt going? Who's owning it? Who's consuming it? What is the interest rates and the yields on that debt? And you want to keep an eye on that. The Fed's policy also affects interest rates when it comes to housing. So you can't fight the Fed is more of a statement about pushing into risk assets, pushing institutional investors into risk assets, but it's also very meaningful in terms of the overall economy when it comes to interest rate policy, monetative easing, or quantitative easing and things like that. So do not fight the Fed.